Hey, Kevin here, top 100 financial advisor and best-selling author, and we are here to talk about the stock market. Had a lot of things happen today. We know about Revvion, it IPO'd, blah, blah, blah about Revvion. That's what a lot of the news has been about. But outside of that, the bigger and what I would say is most important news, more important rather, is inflation. So we had a report, or we had our inflation numbers be reported, however you want to say that. It's 6.2%. Is not what we expected. It is higher than what it was last month. And it's one of the highest numbers we've seen since the 1990s. That's bad because the cost of stuff is going up. If your salary is the same and costs are going up, your money is worth less. That's going to force you to do a few things. Number one, it's going to force you to either find other ways to increase your income. It's going to force you to invest your money more so you can outpace what inflation is. Again, and it's not going to say that, inflation is going to go up 6% every single month. That would be ridiculous. However, if the cost of stuff is going up 6%, I got to do something to make sure my money is still worth the same, if not more. And given this inflationary environment that we've been in for quite some time now, you've got to find out what places make sense to invest, because right now you're seeing a shift. Okay, right now you're seeing, I would say, yet another shift in where the market is moving and how things are changing right under your feet. And you as an investor have to be, number one, aware of it, and two, position yourself for success. Last year, and it was easy last year, super easy to make money last year. It was all stay-at-home plays. Zoom made sense. I've said it over and over again. Even Twitter and Pinterest, all that stuff made sense last year. People were at home. Netflix, throw that out there too. People were at home. They didn't have anything to do. They had to video conference. They had to go to meetings, and they had to stream stuff because they had nothing else to do. Now things are opening up. Now costs are rising. That theme is no longer the case. Disney is not doing as well as it did last year. Zoom is really not doing anything close to what it was doing last year. New year, new theme, and you have to adjust. So, given that, what are, let's say, the top 4 or 5 companies that are top of mind for me that can continue to grow now and maybe even have some longer term implications and longer term growth? So I'll give you my top 5. I'll explain a little bit about why I think some of these companies can make sense, which ones I own, which ones I'm looking at owning here in the very, very near future, and how and why this makes sense. All right, so first, I think there are a few areas that of the market. I always try to start with, what is the case, right? So we have areas of the market, then you or sectors, really, that's the technical term for it. And then you drill down and say, okay, here's a sector I think makes sense. Let me pick through here and see which companies I like. For example, at some point, we're going to raise interest rates. So financials, but that financials and inflation, these are two separate topics. So I still think financials make sense, but just for inflation, we have to shift our focus. So what companies or what industries tend to do well in inflationary times? Healthcare is one of them, because I just went back from the dentist today. And I got to go back again tomorrow, but it's health. I got to go, right? If I want to keep my teeth, I got to go. A lot of times we don't skip out on things that we need from a healthcare perspective. Your leg hurts, you got to do something about that. And that's just the end of it, unfortunately, right? So healthcare is a space that I don't ever like to say inflation proof, but it's one of those places that people go to because it is stable and predictable and that it has to happen. So healthcare is one area that you go to. Energy is another place because, fortunately or unfortunately, depending on how you want to look at it, you still need electric, regardless of what happens, even if that bill is a bit higher. Water, all that kind of stuff. Utilities, you can just box that all together. You're going to need that anyway. So even in inflationary times, those are some places you could go. And I'll also throw tech in there too. Tech is a very, very interesting space depending on what type of tech you're talking about. I say that because if you're talking about tech that depends on chips, not an easy call, or not as easy. If you're talking mostly software that's cloud-based, think of, like a Salesforce or something like that, you don't need chips in the same way. So you actually might be, this might be a risk that does not necessarily apply to you. So I'm going to give you a few of those companies and go forward. All right, so let's start. I've got 1, 2, 3, 4, 5. So y'all are going to get 5. I said 4 or 5. So we're going to stick with 5 here. And we'll start with the one I think is the worst performer and talk about why I think it's still okay. All right, and then we're gonna kind of move up the chain. All right, so I'll start with Square. Square is actually down, surprisingly. It's actually down the last 6 months at about 2.63%. Odd. To me, that's odd. However, I invest in Square, so I own Square now. I'm planning on keeping it. I'm not going nowhere with Square. But the good thing about Square is, number one, well, I don't know if this is good or not. You make a determination. It is relatively volatile. So there are times where it's up really high and times where it's down. If you go look at a chart of Square, you'll see a roller coaster that does go up over time. However, you do want to be aware of that. The good thing, though, as inflation rises, so too does Square's revenue. Why do I say that? Well, the majority of the money that Square makes is on transaction fees, kind of like a Visa. Therefore, let's say you swipe a card for $100, Square is going to make $1. Well, if that is now $200, or if that item is now a 105 or whatever, the higher the price goes, that percentage stays the same, but Square actually retains more money. That is going to be beneficial to Square. The more people are spending, which they are, and we're hitting the holiday season, and they own Cash App, and people are sending Bitcoin and all these types of things, that's still going to help Square. If I were going to jump into it, I would see this as more as I'm getting it somewhat at a discount, and I'm holding it for the long term. This is not something where I would say, I'm looking to make some money now. I'm looking to I wouldn't say guarantee, I'm looking for the highest chance of growth, in the next month or so. You're risking a lot in the short term for Square, but I think in the long term, you're going to put yourself in a very good position. However, as costs are rising, Square is going to make more money. When and if inflation declines to a degree, which we know it will, I still think Square is still in a good position because transaction fees aren't the only way that they make money. So keep an eye out there. Long term, I think, is a no-brainer for them. Short term, it's going to be a little rough, or could be a little rough based on what we know about the company and how it operates. All right, so that was number one. Number two is Eog Resources. I talked about them before. I said healthcare does well. Energy and oil do well. EOG is in that sector. They've done quite well. Last 6 months here, they're up about 15%. Let me go to a year chart as well. So if I look at EOG the past year, they're up 140%. 140 with a capital F there. And then going back to Square's up 23%. And that's not bad. You look at a year, again, long term, I think you're gonna be all right. Short term, gonna be a little more difficult there. So that was Square, that's EOG. I talked a little bit about energy. Again, we also know as things expand a bit more and people are really, really out there, we're going to be using more energy. EOG is, it's really, really on my list. I don't currently own it, but you might see some shifts come moving day at the end of December. So keep an eye out for that and see what I may or may not do there, but I do have my eye on it. Next is Eli Lilly. They are a pharmaceutical company. They're well known. They've been around, I feel like the 1800s. They just feel very, very old. They've been around what seems like that long, but y'all can fact check me on that one. They're up 34% in the last 6 months and 84% in the last year. That's hard to argue. Healthcare ain't going nowhere. If nothing else, that's what we know. So healthcare ain't going nowhere. We can put that on the shirt as well. And the fact that we could be in an inflationary period, all that stuff is locked in. They're not going anywhere. It's a really hard business to lose based on how they've been performing and what we know about the market, at least in the short term. So I see Eli Lilly, super easy, super solid. They've been that way for a little while, but again, they've been around for a while. They're not going anywhere. They're in the pharmaceutical space. You're pretty locked in for a decent to solid performance there. Moving up, we got Danaher. This is a company I've owned for. I'm actually proud of myself for finding this one and getting it at what felt like early. That is also in the healthcare space. They're up about 27% in the past year, and they are at about 15% in the last 6 months. I got it a few years ago, almost 2 years ago now. It was one of the very first companies I bought on public. And y'all know I come back and reevaluate every 6 months. And every 6 months, I'm like, man, y'all get, your contract is extended. You get to stay here. And Danaher has been a money printer for your boy. But it's something that you do want to consider. Again, it's also in that healthcare space. Healthcare in this environment, in an inflationary environment, very easy place to be. Solid, stable, and they you have to have the goods and the things that they produce. So very rarely do you see inflation hit and then healthcare stocks go down. That is rare to see. Same with energy as well. All right, so the last one is EPAM. And let me get the total name for it, because this is a new one for me. I looked at the numbers and I'm like, whoa, hold up. We need to talk about this. So excuse me real quick as I get the full name of the company, because again, it's new for me. EPAM is the ticker symbol there, and it is Epm Systems. So I could have just said EPAM. So Epm Systems is a software company that deals with engineering and product development. And this is really interesting, and you'll see why here in a second. So I said software that doesn't necessarily rely on chips like an Apple. Like, I need the chip to create, well, I guess they make their own chips now, but still, I need chips to create the Mac. I need chips to create iPhone. And these costs are eating into my revenue, but also my margin. So if it costs me this much to make an iPhone, but I'm selling it for this much, and chips are more expensive, then the money that I get to make and keep is lower now. That hurts me if I am an Apple. However, if I'm software and it's all in the cloud and I'm really not buying and using chips and needing materials in the same way, that money's mine. And if costs go up, I can push a button and make those subscription costs higher, just like a Netflix. It don't cost them nothing to just increase prices, because a lot of their stuff isn't necessarily hardware. They got other expenses though. So going to EPAM, let's take a look at this. And this is one that's on my list as well. Again, I learned about this relatively recently. 55% growth in the past 6 months. And over the past year, this one is up 125%. Which is obviously very good. The good thing about them is, obviously, we know they're not as affected so much by inflation. We also know that tech is still tech, and it is still the wave of where people are moving, and it's hard to deny something that's up that high in such a short period of time. So energy and software, based on the list we have now, EOG, EPAM, those are two you got to look at. They're on my list. I do not own any of them yet. I'm waiting until December to really put together my list and see who I need to kick out of my current portfolio before I add more. Why do I do that? Excuse me. The reason I do it is because I can't own and research 50 million stocks. I can't do it. I can't do it. I need to optimize, and somebody's got to go before I add anybody new. And I need just a little bit more data from the market to see what is going to happen, or what may happen, or what is setting up to happen in 2022. I already know that interest rates are going to be a thing, inflation is going to be a thing. Those are two things, as well as supply chain. Those are the three things I can almost guarantee you are going to be themes going into the new year. I can't, because I don't have a crystal ball, I don't know how long those things are going to last. I don't think I knew about infrastructure in December of last year. Now, most people thought that it was going to be like cannabis stocks. People were really looking to those, thinking that was going to happen, and it didn't. Hey, right? That happened. So I like to wait just a little bit longer before I decide to rotate out my portfolio. But these are 5 that are on the list, high on the list really, of what we need to replace, what things we want to add. So again, we got Square, we got Eog Resources, EOG, Squares, SQ, those are ticker symbols. We got Eli Lilly, which is LLY. We've got Danaher, DHR, and then we got EPAM, which is EPAM. Those are the 5 I'm looking for in terms of inflationary plays and places that you might want to look to. Again, notice the nuance here. Square, I think, is better for the long term. This is not something I would just hold for 6 months and make a determination on. I would not do that. That's just me. I own the stock. I know the stock, and it can be up and down. So I told you. Okay. Also, I own Danaher. I've been in it for a while. I don't intend on selling anytime soon. I'm really, really looking at EPAM, and I don't know how I feel about EOG yet. I have not owned an energy company directly. A little nervous because I know energy is up and down sometimes. So do know that as well. So let me know which one you want me to break down further, which ones are you looking into, or which ones you own. Put all that in the comments below, and we'll talk to you guys later. Bye.